QuickBooks Online 2025, managing sales tax, a type of consumption tax. Get ready and some coffee because we're learning how to save time with QuickBooks Online 2025. We are online in our browser searching for that QuickBooks Online test drive, the free sample file available to everybody, looking for a result that has Intuit.com in the URL because Intuit's the owner of QuickBooks, therefore giving us a little bit more verification that we're in a legitimate location. We're going to basically verify that we are not a robot. That should take us into the free sample file, Craig's Design and Landscaping. We're going to open up the financial reports like we do every time, that being the balance sheet and the income statement. Going to the reports on the left-hand side. We're then in the standard favorites, right-click in the balance sheet to open a link in a new tab, right-click in the profit and loss to open a link in a new tab. 3 tabs up top, going to the one in the middle. Closing up the hamburger, we're going to change the range as we do every time, a 10124 to 123125, so that I can then select the drop down and years, run it to refresh it. We got the side-by-side 2024 and 2025 years going to the tab to the right. Closing up the hamburger, changing that range in once again, a 10124 tab, 123125 tab, selecting the drop down to see it year by year for the side-by-side, run it once again to refresh it. Nothing's currently in the 2025 except for that one transaction, remembering that we are refreshing the data each time by logging out, logging back in, this time in incognito window, so to make sure that we have a kind of a fresh screen that doesn't have the prior transactions, just in case you logged out and are logging back in and you don't have those prior transactions. Let's go to this first tab. Once again, selecting the drop down. We're looking at the cycles, remembering we can think about the accounting system as cycles within cycles within cycles. The yearly accounting cycle, then the quarterly cycle, the monthly cycle, and then within each cycle there are cycles that we could break out by customer or sales cycle, vendor or expense cycle, the payroll cycle. We're currently looking in on the vendor cycle. We talked about expense form, checks forms. We'll talk about them a little bit more later. Those forms decrease in the cash account. We talked about a bill form, which is an accrual form, increase in the accounts payable. The pay bill form, which is basically another kind of check form, paying down the accounts payable. The purchase order, which only deals with systems where we have inventory and can request the inventory before paying for it. And now we want to be looking at the sales tax system. Now, I'm going to be thinking about the sales tax kind of in alignment with the vendors, even though taxes are messy. They kind of mess things up. We can think of this as a kind of consumption tax. So if you're not in the United States, you might have this is a similar type of tax that you have in many other parts like Europe, for example, as opposed to having a main tax like we have in the United States as our income tax. In other words, I'm looking at this from this perspective of the United States because that's where I'm located, but there's no real new tax under the sun in essence. It's just a matter of which tax is being applied in any kind of particular location. In the United States, we have a sales tax for the main federal tax that we have to deal with, and then the states might tax however they want. They might choose to also have a sales tax, income tax that mirrors the Fed, or they can have a tax that would be like a consumption tax, which we call a sales tax. So that's what we'll look at here. If I go over to my little flowchart, which again is the desktop flowchart, but I'm just looking at it because any accounting system will have this kind of flow and the forms will be named in essence the same. You will note that they have the sales tax manager up here in like the vendors area. So if we're talking about a sales tax or consumption tax, let's just kind of mull over why that is and how basically this tax will work. Noting also that when we think about the accounting system, it will be the same. It's universal. It's kind of like math when we think about the double entry accounting system in general. It's laws and regulations that change from location to location. The one that has the biggest impact typically on bookkeeping is tax law, because of course that has a direct impact on the financials. And so therefore the taxes are the things that will majorly differ from location to location that we have to keep an eye on when learning accounting, and also when thinking about where we want to specialize. So that's another area where we can say, what kind of clients do we want to pick up? And we might ask ourselves, what kind of regulations do they have to deal with? Do they have to deal with different sales tax? If you're in the United States, for example, you might be saying, do I want to be picking up clients that are in a location possibly that doesn't have sales tax because it's in a location that doesn't have that? Or do I want to maybe specialize in sales tax where we have more complex sales tax needs and make that my specialty area, possibly for people that are making sales on the internet, possibly, and therefore having subject or possibly subject to sales tax in multiple different locations, which adds a lot of complication. All right, what's the general idea with the sales tax? Well, the idea is that if it's a consumption tax, the government is giving a tax to the person that is purchasing the items. That's the concept of it. But they're forcing us as the business owner to be the collection of the sales tax. So we're kind of being forced to be the collection agent, kind of like an IRS agent in essence, or whatever, whoever's collecting the sales tax. So that means that on the customer side of things, we're going to have an issue down here when we make the sale. The two forms typically used to make sales, which we'll talk about later, are the invoice and the sales receipt. So when we enter those forms, if we're subject to sales tax, it's going to be more complex because we then could set up the widget within QuickBooks to automatically calculate the sales tax so that we can charge them properly when we record the sale, which will then increase the dollar amount that we're going to charge by the sales tax, which will not be part of revenue, but instead go into a payable account. And that's when the vendor side of things happens, because that means that the accounts payable is going to be going up for sales tax payable. And then that's why it's up here. That's why we have this item in like the purchasing side of things or the vendor side of things, because we think about, in essence, the government as the person we're paying. So you can almost think of it like we're paying the government for what? For like protection money, right? We're paying the government so that they have the police officers, they have the infrastructure that's set up that allows us to basically do our business. And so we're going to be paying the sales tax. That's one way you might think about it in terms of how it relates to what we're doing, or as, in essence, a business expense. But we're kind of not recording it as a business expense, really, because instead of recording revenue and then sales tax expense, we're kind of acting as though that might actually be a more proper way to do it, honestly. But we're kind of acting as though we're just a collection agency. When we make the sale, we're recording the sales tax portion to accounts payable or sales tax payable, and then we're going to take it out of sales tax payable and basically pay it at that time, which is why we're basically paying out to what we can think of as kind of like a vendor who's providing us with, protection and infrastructure or whatever. All right, so that's the general layout. Now, if I go into the QuickBooks, then most taxes, we saw the payroll has its own kind of widget down here that deals with payroll taxes, which is quite complex. Sales tax is not as complex, typically, depending on the type of business that you are in. So you might be able to get away, in other words, with doing sales tax without you don't have to usually pay extra for the widget, or possibly the question is, do I want to track the sales tax within the system, or do I want to, do it myself and track my own basically sales tax? If you do it within the system, then you'd be in this sales tax system down here. You've got your sales tax. Let's set up your new and improved sales tax items. And you can basically, I won't go through the whole process here. We might touch on it again when we get into our full practice problem in the second half of the course. But you can set up your sales tax items. QuickBooks is getting a lot better at charging the sales tax properly by location. The problem with taxes before, and it's still a problem, is that once again, different locations have different taxes. So you can't universally just do the same thing. But now with the internet and the sophistication of the programs, they can basically look at the location we are in and hopefully use that to properly assign out the sales tax. So when we set up the sales tax, the first thing we would do if we're doing the full service sales tax system is basically set up the sales tax over here And then when we sell stuff using the customer side, the sales forms are the invoice and the sales receipt. Invoice dealing with accounts receivable, sales receipt, no accounts receivable, like at a cash register. Noting, however, that you might also sell things with the bank deposit form, which throws a wrench into the system. You might use that, for example, if you're trying to use the bank feeds to record sales. That's going to mess things up typically, because the sales tax is typically tied to the invoice and the sales orders. So the next thing you need to do then is we have to go into the sales item, and then in the products and services, these are the things that we actually sell that will populate the sales forms of invoices and purchase orders. We have our sales items. Now, as we set up these sales items, we're going to tell the system whether they're subject to tax or not. So if I set up an item here, you can see this one, we could say if it's going to be subject to sales tax. And again, QuickBooks might be able to help us to determine whether it's going to be subject to sales tax. So we're going to turn sales tax on, and then we're going to tell the system whether or not the thing we're selling is subject to sales tax and which sales tax it's subject to if we have multiple locations by the actual thing that we are selling. And in the United States, for example, some things might not be subject to a sales tax. For example, service items often might not be subject to sales tax, whereas inventory items may be subject to sales tax. We'll do this more again in the second half of the course, this whole setup process. And then you might also have one other thing that you have to deal with, which is the customers, because certain customers might not be subject to sales tax. So if I go into the sales area and into customers, let's say that we're selling not to an end customer, but to like the government or something. Well, then you'd have to go into the particular customer and edit the customer. And then way down on the bottom here, if I scroll down, it says taxes. This customer is taxable. Notice the tax that they're going to be subject to is here. So, right, these are the taxes that they're subject to. Now, we could say, well, maybe they're not subject to taxes, in which case the question would be, well, why are they not subject to sales tax? Possibly they're not the end user or something like that. So that's the general layout. I'm going to say, do you want to leave without saving? Yes. So when we set up the sales tax and we're using the whole system, what do we have to do? Set up the actual sales tax items using the sales tax widget, and then add the items that we're going to include to the invoices and sales receipts, the inventory and service items, as to whether they're going to be subject to sales tax and which sales tax. And then as we add the customers, then we might have to then choose certain customers that possibly aren't subject to sales tax. Otherwise, by default, they're going to be subject to sales tax typically as we set them up as per the default sales tax applied to the items that we set up and the location that we're in, if it's like a store, for example. All right, so let's just do a quick rundown of how that might look. So if I hit the plus button, whether we make an invoice or whether we make a sales receipt, we can record the sales tax at that time. We'll talk more about invoices later, but this is the sales side of things, just to get an idea of how the sales tax will work. Let's just call it customer number 1, generic customer 1. I'm just going to save it. And then this one, we would email it to them if we're going to email them an invoice. 30 days for when it's going to be due as the invoice is sent out. I'm going to put it on 1/2. That's fine. And then I'm going to make a new item down here for inventory item, just so we get an idea of what we're doing. So this is going to be in item number 1, generically named. It's going to be an inventory item. I'm going to copy that. And then I'm going to say quantity on hand. Let's say that there's currently 10 on hand. Now, by me doing this, it's going to record like the purchase of inventory because I don't actually have any of this inventory on hand. We're not buying the inventory like we did before. So if I tell the system there's 10 units on hand, it's going to have to record a transaction increasing our inventory by the 10 units and whatever cost we put in play. So I'm going to then say the date. Let's put it back 1 day. I'm going to say the reorder point. Let's just say it's 0. It's going to increase inventory when we buy it, decrease inventory when we sell it with an invoice. The description, I'm just going to call item 1 sales price. Let's just say is $100. It's going to record the sales to the sales of product account. Here's the sales tax. So it's going to say it's taxable. So notice it's taxable here. If it weren't taxable, I'd have to go in here and say that it's not taxable. But I'm going to say that it's taxable and allow it to do the tax. Here's the non-taxable. So we're going to say, all right, done on that. And then I'm going to say the cost, let's say, is $75 an item. And the cost is going to go to cost of goods sold. So let's go ahead and save that. And so now we have our item here. And let's say that we're selling. Whoop, did it not record it? Let's say that we're selling 2 of them. So that's going to be $200. Sales tax is now being checked off because the item told us to check it off. We could uncheck it manually, but you would like that to populate automatically. There's the 200, and here's the sales tax. Here's the point of this. So we'll talk more about invoices later, but they're somewhat complex. All that is being done with an invoice. What's this doing? It's increasing accounts receivable by $216 when I record it. It's increasing revenue by $200 though. What's the difference? $16. It's also going to deal with the cost, the inventory going down by the cost, which I said was $75 per unit, and then it's going to record the cost of goods sold and reduction of inventory, and it's going to deal with the subledger, recording the subledger for the customer, which will track the information by customer, and the subledger for inventory because we're using a perpetual inventory system. But our major concern here for the sales tax is this idea of we're going to actually collect from the customer $216, but we have $16 that's sales tax. Now, there's 2 ways that you can think of doing this, and this is important to note because this will come up when you do taxes if you're in the United States, and that is method number 1. Why don't I just record revenue at $216 and then record a sales tax expense of $16 because I'm basically the one doing the work, charging the $216, and then I have an expense of $16 that I have to pay to the government. And then when I pay it to the government, I should have the $16 expense. That would make sense, but the government is saying, well, no, this isn't your expense. They're trying to act like it's the expense to the person buying it, and you're just the tax collector, right? So that means it shouldn't hit the income statement. So this $16 isn't going to be recorded as revenue, only $200 as revenue. The $16 is going to go into sales tax payable, a liability account, and then we pay it out of the liability. So that's important because at the end of the year for income taxes, people will often ask, hey, look, I paid all this money for sales tax. Where's my sales tax expense, which should be reducing my income so that I pay less taxes for income taxes? And it's like, well, no, there is no sales tax expense. It's not that you didn't pay sales tax expense. It's that you didn't record that in revenue, or you should not have. It should have been reported on the accounts payable if you did it properly using the whole widget system and the invoice, right? So let's see what this looks like. If I go ahead and save and close this, and then I go into my balance sheet and run it, and then I go down to my liabilities, let's just look at the whole thing. In accounts receivable, what happens? Accounts receivable is going to go up. So if I go into the AR, there's my accounts receivable. It's for the full amount of the $216. If I drill down on that, that gives me my invoice for the full amount, $216. Closing that out, going back to my form. The other side's going to go on the income statement. That's on this sheet. Let's run it to refresh it. And we're going to have revenue of the 200. Only 200, not 216. I go into that amount. There's the data, the 200. If I go into it, where does that come from? That's the amount that we charged, not including the sales tax, the extra $16. Where does the $16 go? Let's close that out. Go back to our income statement and then back to the balance sheet. It's going to be a liability. It's on the balance sheet, not on the income statement, as a liability for, I think, where it shows it by who we have to pay by vendor, which is a little funny, but let's go into this one. So there it is. There's the $16 that we have to pay. So that increased the liability, and then also inventory was impacted because we had inventory is going to be reduced because we sold inventory, and then the cost of goods sold over here is here. So the difference between 200 and 150 is the net increase in net income. But we're concerned with this sales tax. So now we've got this sales tax that increased down here. It puts it into an account based on who we're going to pay. This is basically the vendor, in essence, or the government agency that we have to pay in California, the Board of Equalization payable. And so if you don't like the fact that it has this account, you might make a parent account called sales tax payable and then put these as sub-accounts under it so that you can collapse it into one account if you want to, so it doesn't look like this vendor name out there. But in any case, so that means you're going to have to collect the sales tax. And then the question is, well, when do you have to pay it? So you're going to have to collect it, and then maybe you pay it, like if you collect it in January, maybe you pay it in February, or maybe you have to pay it after each quarter. You have the first 3 months, and then you have to pay it for the first month in the second quarter, first quarter sales tax. It depends on the location, but that's how it's going to work. You're going to collect sales tax, and then once you have the money, you're going to have to pay it based on whatever the terms are in the location that you're in, which is where we see it as a payable in essence, because now we have sales tax payable in essence, which is similar to accounts payable that we have to pay to basically the government for the sales tax that we have collected. So how are we going to pay that amount? Well, we could just write, in essence, a check form or an expense type form. So if I hit the plus button, it's going to be a check or an expense. Those are the forms that decrease the checking account. However, it's similar to what we saw with the bills form. Remember, the bills form is like a check or expense form, but it specifically decreases the bill. So if I use the little widget system in order to record this, I should get a special payment check that's going to be for sales tax. So it's going to be, a sales tax payment check. And I would do that by hitting the plus button down here and making the payment through the special little widget down here for the taxes. Where did there it is. And then we're gonna make the payment. Now I don't want to, I have to set up the whole thing, but typically there would be a payment down here that would help us to determine the amount that we have to pay. Now, it's not that difficult to figure out how much you have to pay for sales tax. Typically, if you have the sales tax collection system set up properly, because all you have to do is kind of look at the sales tax for the prior period and figure it out. So the widget isn't doing like as much detail to help you as with the payroll kind of system, but it's still kind of useful to do. The general idea would be that it would be making a payment, which would be, again, a check or an expense form, which would decrease the checking account. Let's go back. I can go back. I'm on the wrong. Dang it. Let's go back into the reports. And then let's go into balance sheet, putting this back in place, 01/01/24 to 12/31/25. And then I'm going to select the drop-down years and run it. So that would decrease, in essence, the checking account, and it would decrease then the Board of Equalization, which if I'm using the widget, it's hard to kind of do an example of because the widget kind of works in real time. At when the thing becomes due, and the practice session here doesn't always have the widget working properly because they're trying to do something that's going to be there all the time. But the general idea is you'd go in there and say, okay, now I'm going to pay the sales tax, and it would make, in essence, a special check form, which would decrease this account and decrease the checking account with a special name to it. Now, what you might be in a situation where you're saying, well, but wait a second, I want to have a simple situation where I'm not going to actually be using these customer forms of an invoice or a sales receipt because I'm just gonna wait till it clears the bank possibly, and then record it as revenue with a bank deposit form. What if that's the case? So in that case, I might not even be using items. So you might come up with a system on how you might do that. You're like, well, that's going to mess everything up because I'm not going to enter these forms every time, but I'm still subject to sales tax. How am I going to figure that out? Well, you might do something like this. Just work it into, of course, the sales price. You might see this in some places where you're basically saying, hey, look, this is how much I sell it for, and the sales is included. So, for example, in our system, let's say that we sell something for $100, let's just say, and then the sales tax rate, let's say it's $5 for generic purposes sake, or 5%, say 5%, percentify that. So that means that the sales tax on the sale is going to be equal to 100 times 5. So that means that we need to collect the amount that we're charged, 100 plus the sales tax, and we're going to have to then pay out the 105 to the government at the end of the day, right? We're gonna collect 105. So when you make the sale, you could say, hey, look, I'm charging 105, which already basically includes the sales tax, right? So you can say, here's the price, including the sales tax, so that you can make sure that you collect the sales tax. Now, the problem with that is when you record the revenue as it clears the bank, this whole 105 is going to go into your sales account. Because if you record it with bank feeds, recording it as revenue, you're going to have cash, which is going to go up. This is I'm using debits and credits, 105. And then you're going to have sales or revenue, or just say income, of a credit of 105. But that $5 shouldn't be on the income statement, right? Because that's the amount that you've got to pay for protection money to the government, and then whoever else is taking your protection. So then what you'd have to do is look at your so you might say, okay, then at the end of the period, all of my revenue that is subject to sales tax, how do I figure out how much of that I have to pay to the government? And then I can just do like a journal entry or a check form paying it to the government. So, but what we'll tend to do there is we'll tend to say, well, my income is 105, right? And my sales tax rate, this is the wrong way to do it, is 5%. So I might then say, okay, that means my tax that I have to pay is 105 times 5%. That's not right. It should only be $5, not $5.25, right? Because if I did that, I'm paying too much because I'm recording sales tax on the sales plus that already have the sales tax included. So then the question is, well, how do I extract, the sales tax? So that in essence, we're looking for it like this. For an algebraic problem, it would be sales is what we kind of don't know. And then the sales tax rate is the 5%, and then the tax is what we don't know, and so we know how much we collected, which is 105, right? And then we can back into, using algebra, back into the sales number here. It might be easier to see if I rewrite it this way. If I say the sales are here. Oh, that's not right. Sales are 100. And then if I take the sales plus tax rate, that would be 1.05, 105%, 100% plus the 5%. So the amount we collect is going to be this times this. That would be the 105. So if I back into this, if I knew the 105 and I'm trying to back into how much sales I make, it would be, okay, if I knew the 105, sales I don't know, I know the rate is here, and then the amount that I collected, if I know that, then I would back into this number here, right? So it would be X times 1.05 equals the 105, and then you're solving for X. So 105 divided by the 1.05, right? And that, so like if your sale, like if I didn't, this is one sale. So if my sales, if I happen to look at this and I say, I don't know what my sales are, I know what this is, but the amount that I collected that I recorded as revenue is like 2,000, right? Then I can apply this formula to back into the sales because I would have multiple sales, right? So I would say, okay, well, that means that X times 1.05 is equal to 2,000. So I'd have to take then this divided by this. And if this is what happened when I recorded the revenue, of the 2,000, that would have gone through the bank feeds. It would have been cash, would have gone up by the 2,000. And then I would have recorded income of a credit of 2,000. But this is overstated. The credit should only be 1,904. And so what I'm going to do is I'm going to write a check to the government for the amount of tax that we owe, which is the difference between these two. So 95, which is, so now I'm going to say cash is going to go down by 95. And then we've got the income is going to go down by 95. So if I net these two out, the income here, it nets out to that 1904, right? The 1904. So I just want to point that out because you might try to come up with a more simple system where you're not using the whole recording sales tax as you go, but you still want to be in compliance with sales tax, but you don't want to have to record each sale within QuickBooks. So, and then you have to figure out a way that you could still track the sales tax properly in a more simple system, but try to be in compliance. So I just want to kind of point that out because again, if you don't use these forms and you're trying to automate things with the bank feed, you're going to use the deposit form and you're not going to be in your whole sales tax widget won't quite work. And you might say, well, that's going to mess everything up. It will, but again, sales tax is not as complicated, at least as of now, as the payroll tax, depending on the type of industry you're in. And so you might not, at this point in time, you don't have to generally pay extra for calculations of sales tax, and unless you have a more complex system like taxes in multiple states and whatnot. And even if you don't use the widget that's in QuickBooks, you still might be able to come up with a system that works for like a simple small business that still has to deal with that sales tax or consumption tax component.